Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on December 19th, 2022. Reminder, we trade tomorrow at 11 o'clock Eastern Time. As always, I'm going to review our results from last week, the trades we did, and I want to take a sneak peek at two possible trades, both little pieces of investigation generated by emails or by questions during our live seminars. Last week's income, there's a bunch coming in. If you notice, we continue to roll core positions. Many of you join those positions, take up those positions in the middle of the cost basis that we have posted on the website. These are income generators. These are cash generators, and you can see the rates of return are very, very, very large. And to that point, last week we well exceeded our goal, and I know that this week we'll be doing the same insofar as we're going to be trading into January. There'll be no trading, no alerts, no emails between Christmas and New Year's. And it's a short period of time. Often when Christmas falls in the middle of a week, New Year's falls in the middle of a week, you have 2 weeks of chop, and you try to start getting going right after New Year's and Christmas are on Sundays. So we have actually a very abbreviated period of time where it's not a very good time to trade. And so you can see the rates of return are up, and that the capital we're using for roll trades is working for us very well. For those of you new and are unfamiliar with some of the things we do in Options Income Blueprint, or you're thinking of joining us as a member, we focus on cash and income first based on annualized rates of return. These are absolute rates of return, but take a look. I mean, roll trades 1.1%, do that 50 times a year, you're up at 55% annualized return. It's not that we do 55%. But these are the metrics in the service that are used to evaluate performance. And given volatility in the market, especially because of the Federal Reserve announcement, you have the luxury of the market not knowing what to do. And you may consider it nerve-shattering, but it's also a luxury in terms of when you're trying to generate cash. So these returns on roll trades, which are becoming close to the norm, we've been doing this for a long time, but they've been accelerating, and you can expect that in the future. I think the market's going to be bumpy, as we'll discuss in a second, for the next 6 months concerning the direction of interest rates in the economy. The Fed spoke. Many on Wall Street, again, seem surprised, and at the risk of getting into, I guess would be an old crossword puzzle word, arcania, which is bizarre trivia or whatever, is there are several things that come out in the Fed announcement. If you go to the CNBC website, they will literally show you a corrected version, previous announcement, current announcement. There were like 3 words changed. However, 2 things did happen, which spooked the markets. One, we'll talk about the analytical one first. There's something called a dot plot, and it's based on the Fed governors and what they release in terms of their conversations with each other, where they expect interest rates to go. And it's a dot plot that says we're going to peak in this quarter at this rate. And the dot plot showed that the interest rates would peak, perhaps, this is all, of course, a guesstimate by the Fed governors, would peak a little higher than the bond market, which means also the equity markets were predicting. And that, I think, was a technical correction in the bond market, which had been completely hammered this year, and that spills over into equities. The second, and I kid you not, was Dr. Powell's visage, as they say on CNBC or Bloomberg or wherever I heard it. He seemed very stern and firm. Well, that's a reason for a gigantic 2.5% sell-off or whatever it was. He was affirming what was in the notes, which is we're not changing our mind. And he was saying we're going to beat back inflation, et cetera, we're going to do with interest rates, et cetera. But the street just didn't like the way he did it. The analysts that I follow and either like or are helped by or agree with all agree that what the Fed is doing now is to maintain Fed credibility. Increasing interest rates does not impact the price of food. It does not impact the price of gasoline. It does not impact supply chain issues and COVID lockdowns in China, and so forth and so on. But it was a matter of first reestablishing and then maintaining credibility with Wall Street. And that, of course, has people jumping up and down for the next 6 months on Wall Street. Are we going to have a bad recession, mild recession, statistical recession, and so forth and so on? Well, I'll discuss about what we're going to do going forward and what we'll be doing in the welcome session in January. The bottom line is the bond market overreacted based on where the bond market ended up, and the bond market thinks that the dot plot is too aggressive and that we won't get there. And independent of what happens with the dot plot, what happens with the Fed and interest rates, it's always time to trade. So for a period of time, for several years, Chewy was one of my favorite companies, which made it one of my favorite stocks, which made it one of my favorite names to trade. And we did really, really well. And it's time, we left it, I think I don't remember it with the last, clearly the numbers, we ended up making a lot of money, as you can see. The last trade might have been a little bit of a downer. And it was because we got out before earnings, and I was assuming we were getting back into earnings. But the bottom line was a couple of 3 quarters ago, maybe a little more. It was a post-pandemic letdown and post-pandemic crash. Management was not clear about how they were going to fix their inventory problems and their margin problems. And the margin problems were obvious, which was because of increased labor costs, increased shipping costs, and the inventory issues were they had an excess of inventory and so forth and so on. So the bottom line is their earnings came out and they were really good. And we're going to get some specifics in a moment. But the thing that I like about the company now coming out of earnings was they were transparent. Their margins went up significantly if you're a retailer, which in essence they are. And they're getting belatedly into what are called vendor-sponsored ads. Apple is now doing it. Amazon does $30 or $50 billion a year in it. They're not inventing anything. They're just joining onto a trend. Darden Restaurants, we haven't traded in options income blueprint before. One more down leg in the stock, and we might. It's the owner of Olive Garden, Longhorn Steakout, and other what are called fast casual restaurants. It's very well positioned in 2023, and at the risk of being glib, Olive Garden, for a long time on Wall Street, has been known that the company lives on the cheapest amount of dollars per calorie. And I think that's unfair. When my sons were younger, it was one of the few safe places when they were with their friends and we were on vacation to take them where we didn't have to mortgage our house to be able to pay for dinner. If you take a look at Chewy's earnings, the important part here, I'm going to let you digest this, but the important part were some of these numbers. But the two things for me was, as I said, management transparency and the expansion of gross margin. And it was a little, you can see that 28.4% number, which was 200 basis points higher than it was in the previous quarter. A trend, B reality. Those are pretty good numbers for a retailer, and the trend was even more important. The other important numbers, and you can always get it from the transcript on the website from the earnings call, the press release, is the number of auto renew customers increased. They picked up share, and so forth and so on. So in terms of 2023, when we might trade it, these all set the stage for doing it, meaning I haven't traded for 2 or 3 quarters. I didn't like what management was saying or how they were saying it. I didn't like the gross margin experience. Bottom line was, oh, wow. Plus, they made money, which I wasn't expecting. They made a few pennies. And this stock has always been rated on growth and gross margins, revenue growth and gross margins and customers, not on profits. And 2023, we'll probably see a year for 4 quarters of profits. And here's, the auto ship customer sales are really important. When I had a dog, you put it on auto ship, shows up, you don't think about it. My 2 sons between them have 4 dogs, 50 pounds, 75 pounds, 85 pounds, and 10 pounds. And they're Chewy or Costco people, depending upon what they're buying. Some of the dogs eat food that come in at Chewy. And I guess I think it's the 75 pounder that requires Costco, giant bags, whatever, which are inconvenient to ship. Bottom line here is this is important number post-pandemic. and it came, you'll see the 3-year chart in a second. Well, let's go there right now. It was a post-pandemic, it was a pandemic high, and then you come down. And we've hit that post-pandemic bottom. We've seen so many stocks that went up and companies that grabbed share of mind or share of market during the pandemic. And now we've stabilized. This is a very sweet chart for trading. I was waiting for earnings to see if management had fixed the problems that I had foreseen, and they have. So you can see the earnings announcement. We come up, we come back down. This is a short-term chart, 1 month chart, and we're back here. So in my opinion, we're ready to trade, and we'll be trading it hopefully sooner rather than later in 2023. The question is, will $40 hold given market tumult, given concern about consumer spending? Is this a longer-term floor for Q1 2023? We'll know. I think we'll know by the end of the first week of January. The corollary to trading Chewy is that they're gigantic premiums. They're well off the norm of what we experience. And the bottom line is I expect us to be able to trade it and sell puts very, very, very distant from the strike price, from the share price. A true candidate for solid puts. Now let's go to another company, and this was from an email, Darden, Olive Garden, Texas Roadhouse, a bunch of other fast casuals. They had pretty good numbers compared to Wall Street's expectations. If you rip through the numbers, you can see what they were doing in terms of inflation and in terms of organic growth per outlet, per restaurant. They were sort of treading water, if you want to say, but that's a good thing. Many restaurants have not. And Olive Garden does not have a big beer, wine, and bar business, which means they have a different margin structure and a different revenue structure per customer and per shop. They call them stores. A restaurant calls stores. If you ever go to an analyst meeting, which you're always invited to, some analyst who just brand new to the restaurant business will say, I didn't know you owned stores. Restaurant transcripts and things like that from publicly held companies call them restaurant stores. So you can see the highlights were, they were all right. And all right is good enough for me to trade if there's volatility, if I like the way 2023 is shaping up, and so forth and so on. And I didn't want to bore you with some of the minutia of their earnings. But when you took out new restaurant openings and you took out inflation, as I said, they may have even been negative in terms of same-store sales growth. That isn't a bad thing, okay? But it may be enough for us to trade. It certainly doesn't say you should be trading this. It's going to have a great first quarter. Now, remember, I did this in response to an email, and I thought it would be appropriate to share it with you. But the bottom line is they're doing all right to good. That may or may not be good enough for us to trade. Now, if you take a look at the chart, we're near the 3-year top. Pandemic. You're near a 3-year top, and it's a very well run, very well run chain, And I actually know from family someone who worked at Texas Roadhouse, and I eat there for that reason, maybe once a month. It's a shockingly efficient operation, as is Olive Garden, actually. And so management's on top of things, even with a large distributed base of restaurants. But the question is, will we punch out? So you take a look here, earnings came out. The street was disappointed because there have been post-pandemic bounces in a lot of restaurants. But those are the restaurants that have a bigger, because Olive Garden completely dominates this Darden's earnings, that have a big bar, beer, and wine business. And so they don't benefit from that. They don't benefit from people watching the NFL and watching the World Cup. They don't benefit from that. So I think Wall Street was overreacting because they weren't fully understanding what these restaurants are all about. So trading it started with an email. We typically don't trade stocks. The stock's well above 100. It only has monthlies, and that can be difficult for some people as well. And the premiums are fine, but they're not great. And here's the bottom line. We're not going to trade it yet, which is understandable. And the reason I juxtapose this against Chewy, you can see the logic of going from the real world, auto ship renewals, solid growth, transparent reporting of financial things, to DRI, to Darden going, it's pretty good, but are there better fish to fry, so to speak, pardon the pun. And there's a whole bunch of things that would have to happen for us to trade it. And I wanted you to understand why we trade some things and why we don't trade the others. So trading this week. Will the market calm down? Logic says it probably should, but it might not. Is short-term support in the S&P 500, 3850 going to hold? The next leg down seems to be 200 S&P points ratcheting down when the market really is in a bad mood. And trading is very light as many other holidays. So we will put on new trades this week. They're going to extend into January, as will our rolls. And in the OIB welcome section, for those new members who are brand new, who've never been, once a month, welcome session, answer questions, but sort of forecast what we're doing, discuss how we do things. There'll be a pretty in-depth review of what we'll probably be trading in the first quarter, especially with earnings. They start, Delta Airlines kicks it off for us in our universe of stocks in the second week of January. This is Michael Schulman. Thanks for listening.